Hey everybody, welcome back to our unit on fixed assets here in Accounting 1101. In our video right now, we're going to be taking a look at how to calculate straight-line depreciation. Now this is a topic that you've probably seen before, especially if you've come through solid footing, and we're going to revisit it, and hopefully by the time we're done, you can make that calculation with no problem whatsoever. We've been looking at Kings Island as our example as we talk about fixed assets and talking about the Diamondback roller coaster and how Kings Island had paid $22 million to get that thing up and running. And they recorded that $22 million at cost in property and equipment on the balance sheet. And we have a separate video where we talk about everything that goes into cost for property and equipment. Our concern today is taking that cost and spreading it out over the useful life of the asset. In this case, about 20 years on a roller coaster at Cedar Fair, the parent for Kings Island. So we're going to make our straight line calculation and take that and spread it over the useful life. So we need to know four things in order to calculate depreciation on any asset, regardless of how we're going to calculate it. Four things need to be in place here. First of all, we need to know the initial cost. We need to know the purchase price of the asset. And remember, that includes not only what we paid to get the asset, but also what we paid to get it ready to be used, okay? So that initial cost, Diamondback, $22 million. We also need to know useful life, how long we expect to be able to use our asset. And that's an estimate. As you can see back on the Kings Island example, they say the estimated useful life, about 20 years. Maybe a little bit more, maybe a little bit less. But we need to have some kind of a number for the estimated useful life. We also need to know the residual or salvage value. You'll see those two terms interchangeably. That's the value of the asset at the end of its useful life. And that's an estimate also. We don't know that number for sure. We're just taking a guess. We might say that maybe the Diamondback will be worth $2 million at the end of its useful life. Maybe we could take it and scrap it down and get $2 million out of it. And so that would be an example of the residual or salvage value, what we could get out of it at the end of its useful life. And then finally, we need to know methodology. We got to have a rational and systemic way of calculating the depreciation. Straight line and double declining balance are the two methodologies that we're going to learn here in Accounting 1101. There are others. If you want to know about those, you need to take intermediate accounting and become an accounting major. If that's not a good advertisement for becoming an accounting major, I don't know what is. So if you remember back to our solid footing days, we have two different accounts in play here. When we calculate and record our depreciation, we have an expense account, depreciation expense, the normal debit like all our other expense accounts, and we record depreciation for the current period only using that account, and that will show up on the income statement. We also have that contra asset accumulated depreciation that works to offset the fixed asset account, and it has a normal credit balance as a contra asset. It holds all the depreciation that we've recorded over the life of the fixed assets, and that shows up on the balance sheet as an offset to fixed assets. So calculating straight line depreciation, we need to know four things here. We need to know the cost, we need to know the useful life, we need to know the residual or salvage value, and we need a methodology for calculating the amount. So just a simple example here, we have a delivery truck. ABC Delivery has bought a truck. They paid $24,000 for it. They expect to be able to sell it off at the end of its life for $2,000, and they expect to be able to use it for 5 years. If they were going to straight line it, that would be the methodology. And so we're depreciating $22,000 of that vehicle. We'd take the initial cost, subtract out the residual value, and that means we're depreciating $22,000. That would be our depreciable cost, spreading that $22,000 over the useful life right there of 5 years. So straight line depreciation provides the exact same amount of depreciation expense for every year of the asset's life. We're spreading it out evenly over the life. most widely and commonly used method for depreciating an asset because it's easy to understand, it's easy to calculate. This is what most people do from a financial accounting standpoint. So if you learn how to do this well, you're going to be set in most cases. Let's do an example. Go back to Diamondback here. $22 million that they paid for that roller coaster. We're going to assume a salvage value of $2 million, and we're going to say that that makes our depreciable cost $20 million. Cost minus our salvage value is the amount we're going to depreciate. So $20 million, and we're going to spread it out over 20 years because that's our useful life on the roller coaster according to Cedar Fair. So calculating straight line depreciation, real simple calculation. We take the cost, we subtract out the residual value. That's going to give us our depreciable cost, and then we're just going to divide that by the useful life. So for Kings Island, Cedar Fair, that at $22 million would be what we paid, our historical cost. We'll subtract out $2 million salvage value. We get $20 million in our numerator. We divide that by 20 years, and we get annual depreciation of $1 million a year. And again, if you wanted to kind of break that down and do it monthly, we could divide that by 12 and get a per month amount. If we were making our adjusting entry monthly, we could do it like that, no problem. So pretty simple calculation. We can also look at straight line as a percentage amount, as opposed to doing what I just showed you there. We can calculate our straight line depreciation by converting the annual depreciation to a percentage. And the way we do that is we'd make a fraction by putting 1 over the useful life of the asset. So for a 20-year asset, like the roller coaster we looked at, we'd put 1 over 20, and we get 5% per year. And we depreciate the roller coaster at 5% every year. We'd take that $20 million depreciable cost, multiply it by 5%, and get $1 million. So there's really kind of 2 ways we can calculate straight line. We can do it by taking the little formula here, cost minus residual value, divide it by the useful life, or we can make it a percentage. Take the useful life, put that on the bottom of a fraction, put 1 on top to make a percent, and then take that and multiply it by the depreciable cost. Either way, get you where you need to be. So back to our example with the delivery truck. $24,000 initial cost. We need to know the initial cost. The $2,000 salvage value, we need to know that. We subtract the salvage value out of what we paid, and we get the depreciable cost. That's the amount we're trying to spread over the useful life here. In this case, useful life being 5 years. So $22,000 divided by 5 gives me $4,400 a year. Again, we could have taken and made a percentage out of it. 5-year life, 1 over 5 is 20%. So I'm depreciating 20% every year. Exact same thing. Making the entry. At the end of the period, just to use our truck as an example, we debit the depreciation expense account and credit the accumulated depreciation. That is the entry we make every time we record our depreciation. It never changes. Debit the expense account, credit the accumulated account. The financial statement impact of that particular entry, you can see we're lowering retained earnings because we're recognizing the expense on the income statement here. We're also lowering the asset account because we're kind of offsetting the fixed assets here with the accumulated depreciation. And so 2 hits here, one on the asset side, one on the retained earnings side, on the equity side. So hopefully that will give you an idea of how to calculate straight line depreciation. Again, that hopefully was a review. You already had a little bit of an idea on how to do that and give you a little bit more practice. We'll have a homework problem or 2 where you calculate that for me and get that locked in. In our next video, we'll talk about a brand new way to calculate what we need to depreciate called DDB, double declining balance. We'll also follow that up with a little video explanation of how to handle a partial year of depreciation. What happens if we buy an asset in the middle of the year or even in the middle of the month? And then finally, we'll wrap up with a talk about how to handle the disposal of a fixed asset. All kinds of fun topics still to come in fixed assets. We hope to see you back for all of them. Take care, everybody.